Welcome to 3 and 3. Today we're going to be talking about the Fed dot plot, US debt and issuance, and US corporate bonds versus government bonds. So the Fed dot plot. Each quarter, the FOMC updates their economic projections, including expectations for the federal funds rate. The goal of the Fed is to achieve a strong unemployment rate and stable inflation. Their forecasts show that rates could remain high throughout 2024. As you look at the Fed dot plot, the market is expecting about a 1% drop in the Fed fund rate throughout 2024, whereas the Fed dot plot is only expecting about a 0.5% decrease. U.S. debt and issuance. In September 2023, the U.S. federal debt passed $33 trillion, around $2 trillion more than a year earlier. The U.S. government plans to accelerate the size of its auctions to handle its heavy debt load and financing costs. They're going to be focusing on shorter duration maturities and less on longer dated debt. These auctions are important as they provide a window into where rates are headed. Some ways the U.S. government can get out of debt are cutting spending, increasing revenue, new taxes, and a higher retirement age. So as you look at the national debt over the last 100 years, you can see that dramatic acceleration after 2002, and more importantly, after COVID. And as you look at the intergovernment holdings and debt held by the public, you'll see that in 2013, the debt held by the public was about 12 trillion, and today it's around 26 trillion. We haven't seen as much growth, though, in intergovernmental holdings. The Fed actually has been reducing their balance sheet, as you can see from this chart. They expanded it during COVID, and now they're slowly trying to actually, through quantitative tightening, reduce their actual balance sheet. And that means selling that debt into the public, which is also a reason that interest rates have been rising. U.S. corporate bonds versus U.S. government bonds. So bonds can act as a necessary balance to volatile equities and portfolios. Yield to worst shows the lowest possible yield of a bond if the bond does not default. Yields across bond indices are elevated well above their average since 2009, following recent interest rate increases. The highest rated corporate bonds have strong balance sheets compared to governments. As you can see, some of the yield to worst that we're currently showing in 2023, you can expect to get potentially over 6% yields in some very highly rated corporate debt. Thank you for joining us for 3 and 3.